Firstly, as you know, rate of change matters the most, not outright. And the rate of change of liquidity has been improving all year. And by most measures of liquidity, whether using global M2 or other measures of liquidity, we've seen an ongoing improvement in it. The balance sheet use is kind of the real juice on top of that. And we have seen bits and pieces here and there of balance sheet use, but that's not been the big driver. The big driver has actually been the net liquidity measures in most countries. And Fed net liquidity, I know you've talked about this as well, is really when you take into account the three main pillars of liquidity in the United States, because the US is the main liquidity driver. We'll talk about other regions later. Yes, the Fed are doing QT, but that's been, and in addition, the Treasury were increasing the Treasury general account. And for a while, that was breaking the bond market. The last leg of the bond market was the bond market going, no, we can't deal with this new issuance because liquidity conditions are too tight. And then the reverse repo started draining, and the reverse repo has dropped a gigantic amount and will probably drain to somewhere near zero. And that has offset all the liquidity. In fact, liquidity is up on the year. The Fed net liquidity is up 12% this year. That has a multiplier effect due to debasement effects and just general liquidity. And so, that 12% led to 20% in the S&P, 48% in the NASDAQ, and call it 150% in crypto. Financial conditions lead global liquidity by 5 months. And financial conditions have been, they corrected somewhat as stocks corrected, or certainly NASDAQ and stuff corrected, but really it's now going up as the dollars come down, commodities have come down, and rates have come down somewhat. So global liquidity 5 months out should continue to increase. And that you can also see that when you look at it versus ISM. Let's have a look, see if I can find the chart for you. Can't find the chart. Yeah, here we go. So this one is weekly liquidity versus ISM forward-looking, i.e. 15 months inverted. The reason that occurs is because we're in this perfectly cyclical pattern that I talked about last time I was on the show about the everything code, which is where global rates reset in 2008 at zero, and all governments refinance all of their debts between 3 and 5 years. So you're getting this perfect 4-year cycle that repeats. That perfect 4-year cycle suggests that global liquidity just keeps going into 2024 and into 2025. And so we've just used that as the main guide. Now, it won't be perfect, but it feels that way because election years, what usually happens in election years? Well, stimulus. Then we look at global liquidity and say, well, what's happening in China? Well, they've got a deflationary bust going on right now, and the outcome will be more cowbell, be more liquidity. The Europeans are looking like that they're going to be the first to cut rates. So there's liquidity. So everywhere I look, and the UK will follow suit at some point as well. So in which case, the main liquidity drivers of the Fed, the BOE, the ECB, PBOC, and the BOJ had been easing all year with yield curve control. We'll see what they do as well.
Hey, Crypto Mavericks. Welcome back to Crypto Street, where we break down the crypto roller coaster in style. Hit that subscribe button, buckle up, and let's dive into the recent drama of Bitcoin's price hustle. Bitcoin took us on a wild ride, flirting with $45,000 before slamming the brakes. What happened? According to CryptoQuant's Sleuthionce, it's all about profit-taking during BTC's short-term retracement. Short-term holders and the 6 to 18 months crew decided it's time to cash in those BTC gains when we broke $40,000. The proof? Binary Coindays destroyed CDD, got busy, indicating recent moves by the short-term gang. It's like a crypto chess game, and the pieces are in motion. Who's making the big moves? Miners in Wales, my friends. Last week, they were selling assets like hotcakes when BTC hit $44,000. The miners even had a 40% profit margin. Smart moves or what? But hey, Bitcoin's still rocking around $41,000, showing resilience like a crypto warrior. Remember the most interesting man in the world? Well, he's back, and this time he's got a crypto twist. Jonathan Goldsmith, the Doge Iquiz legend, is now raising a glass to Bitwise Asset Management's Bitcoin ETFs. Who saw that coming? In a slick ad on X Twitter, Goldsmith ditches the "Stay thirsty, my friend's" tagline and embraces a crypto message. From Doge Equiz to Bitcoin ETFs, this man's got range. It's like seeing your favorite character in a new season. Unexpected and exciting. Bitwise is making waves not just in the crypto space but on the screen too. Their move to have Goldsmith endorse their Bitcoin ETFs coincides with a crucial SEC application. This isn't just a cameo, it's a strategic play in the crypto marketing game. Let's continue our discussion with Raoul Pal.
I think people are confusing current economic conditions with the recession that they desperately want versus the markets discounting it, the forward-looking stuff like crypto and tech discounting it in 2022. They all had raging bear markets. Right now, we've got the Russell 2000, oil, copper, all of these things in present-day slow economic conditions. Do we get a full recession or not? Doesn't really matter. It was priced in the stuff that I care about. But the forward-looking stuff, all of the forward-looking indicators from ISM are all pointing firmly higher. So we're around the trough of the cycle. Doesn't mean inflation picks up from here. In fact, because inflation's so lagging because of owner equivalent rents and wages, that it should continue to deflate all of 2024, particularly at the core level. And the headline level, we think, continues to fall. So, we're still of the camp that headline inflation probably gets to zero next year and core inflation too, which I don't think anybody's prepared for because everybody's on the sticky inflation camp. Now, let's worry about inflation in the next business cycle when it heats up. Not at the beginning of the business cycle. That's the macro spring to summer transition is generally falling inflation, rising growth. And that's what we're seeing. All the forward-looking stuff is clearly macro spring into macro summer.
So where are we in the cycle? This is not a late cycle dynamic, is it?
No, this is early cycle. It's exactly as it should be. So we've had the ISM troughing, all the forward-looking indicators pointing up. The business cycle dominoes mean that the things that the Fed look at, inflation and unemployment, are the last shoes to drop, which is why they've been very slow on this cycle. So what they will see is unemployment rising somewhat. Nobody expects a massive rise in unemployment, but a bit stickier. And I think AI and stuff like that will make it stickier. I don't think most of the jobs lost in Silicon Valley are coming back. So people have to reorganize themselves and to find different work and stuff like that. And then inflation, I think, continues lower for, at least next year. And then it'll start picking up again, as all business cycles do. And I don't know where the story that it's the 1970s all over again comes from, because I don't see it anywhere in the data. Of course, inflation will pick up next time. Of course, the year-on-year effects will make it look stronger. So we will get a rebound in inflation. But the reality is if you think that wage earners have the power versus a world of AI and robotics, that's a different world. This is not the 1970s of your parents.
That wraps up today's crypto news highlights. Stay tuned for more updates, insights, and analysis from the world of cryptocurrencies. Please share your thoughts in the comments below. Don't forget to like this video and subscribe to our channel for more engaging content.